how are you structured in your business? Am I structured in a way that actually doesn't overexpose me to taxes? And how do you know, right? One of the big things that I talk with people about is, making sure their entity structure is appropriate for their business. So what are these structures? We have single member or multi-member LLCs. And for tax purposes, these structures don't mean anything. The IRS kind of looks through that LLC at the um, underlying nature of it, whether that's going to be somebody like a single member or sole proprietor, versus some multi-member, which is a partnership, right? So they look through that LLC to determine exactly how it's going to be treated tax-wise. So if it's just you, sole proprietorship. If it's you and somebody else, or multiple members in that LLC, it's going to be treated as a partnership. And what does that mean? Okay, so sole proprietors by nature are highly exposed to taxes, namely self-employment tax. It's fine when you're not making a whole lot in your company, but when you start making a lot of money inside of your business, then you want to start making the shift to not have to pay so much in self-employment tax. Partnerships are the same way. Let's say you have two general partners and both of you are actually working in the business and providing services for the business and for the company. One is doing more so the admin function, and the other one is doing all the operations and logistical functions with the drivers and everything else. And you're both exposed to self-employment tax. Okay. All right. So you want to understand like the ramifications of that. Now, if you have not elected to be treated like something else, let's say, for example, an S corp, right? If you haven't elected to be treated like this, then you're going to be overly exposed. The benefit of S corp is that you have limited exposure to self-employment tax, and it's really limited to the wages. Okay. So whatever the wages that you're going to take are the only part of your income from the business that's going to be subjected to what we call the self-employment tax. And if you just don't know what self-employment tax is, it's that FICA tax that you would normally see on your paycheck. If you're a W-2 wage earner, you ever see that, Social Security, Medicare, that's what that is, right? Now, they call it self-employment because when you're an employee, you see your portion of this tax, the FICA tax, the Social Security and Medicare tax. That's what your contribution is into that. But then the employer who gives you that paycheck has the other half of that they pay into that. That's what you don't see on your paycheck. But the employer, they do. They know they're paying, their portion of your FICA taxes. Now, what happens when the employee and the employer are one and the same? Well, then you get both sides of that. So, typically, if it's just the employee, it's 7.65% that you would pay in your, Social Security and Medicare taxes. But, and the employer would pay the other 7.65%. But since you're both, it's 15.3% is what you're paying in self-employment tax, right? Now, this is the thing that you're overly exposed to if you haven't elected to be an S corp, because all the net income by the business, if you're a single member LLC or a multi-member LLC, is subjected to that 15.3%, in addition to your federal income tax, in addition to your state tax. Okay, so it's really good to know, because it can add up very quickly and it's going to be a large number. If you don't have a structure in place to manage this, then you're going to be overspending. Okay. Now, the thing about the S corp is that wage is your is your limiting factor when it comes to self-employment tax. So the rules are that the only thing that I pay self-employment tax with is through that wage. Everything else is just subject to ordinary income tax. All right, we call that a distribution income, and you don't pay any taxes or any self-employment tax on that. It's like a passive income stream that's only subjected to ordinary income tax. Now, your wages that you take as a shareholder of your S corporation, those are subjected to your FICA taxes, Social Security, Medicare. You can see those on your paycheck, your pay stub. And since you are the employer and the employee, it's transparent on both sides. You'll see it from both ends. Okay. Now, the other thing that comes to mind when we're talking about structure, bear with me a second. is, C corps. What if you have a C corp? So the C corp is a funny beast because if you understand how to use it, then it can be like a real good, like, beneficial structure for you. And it's not a structure that is recommended a lot of the times for small trucking companies like you, right? But it can be, right? If you understand how to manage what we call the double taxation of it. Now, if you are actually owning this business and you don't need to take all the income from this C corp, you can let the earnings stay within the body of the C corp. Then it could be a really good structure for you. Um, and let me just share something, let you know when it's not a good structure. I had somebody come to me a couple of years ago. They had been in um, a C corp structure for their business, not in a trucking company, but they've been in a C corp for their business, and they paid double tax on this structure because they're taking all the income out of C corp. They're extracting it like almost like one of these pass-through entities, like an S corp or partnership or sole proprietorship, and because they're doing that, they're getting double tax. They actually were paying more than $30,000 a year for their structure, right? In taxes, more than 30,000 overpayment every single year for more than a decade. What could you do with an extra $30,000 per year, right? And that's more than $300,000 over the course of a decade that could have been going toward retirement, could have been going toward a real estate. It could have been going toward um, your children or your grandchildren, their legacy, right? It could have helped you through like some challenging financial times where they would have been less challenging if that's you. Okay. But the thing you want to understand is with a C corp is that it's taxed by itself at the corporate level, and then whatever income you extract from that business, from that body, is taxed at the individual level. Completely different than anything else. So strategically, if you want to work with a C corp, you can actually take out just enough income as a wage and let that just be the portion that gets taxed, from you, right? Because it is a deduction from your C corp, is a wage that's paid to you, right? And you don't take a dividend from it, so you're not experiencing the double taxation on the profits. All right. So great. What I want to leave you with today, all right, and we started this talk about entities and structures, and you know I really want to know, like, the things that you guys are thinking about when it comes to this area of life, right? Sometimes you think about, it's I just don't want to deal with it, or it's you know too hard to even manage for me and my company, or I really just don't want to go to jail, so I just let the pros handle it, and I don't have anything to do with it. And what I really want you to get is that if you understand some of these things really well, you can play this game at a significantly high level and create wealth, freedom, legacy for yourself, for your family, for generations to come. All right. And the idea behind this talk is to make sure that you're playing this game all year long, to make sure you are executing. It's not something that you just think about one time a year. You want to think about this every single month, throughout the year, have the game plan, have the execution.